If a book can change the way you see the world, this is where you'll find it. I'm Karo Chun. Let's explore together the books that truly shape our destinies. Today's deep dive book is The Great Game by John Gordon. Let's start with a simple question. Have you ever felt confused about the capital markets? You hear on the news that the financial markets matter a lot. But when you look at candlestick charts, or hear terms like bull markets and bear markets, it all feels like some mysterious foreign language. Or you see headlines like "The Federal Reserve hikes rates," or "Stocks are volatile." And you want to understand what any of this has to do with your own life. Yet you just can't find a clear, digestible answer. If that sounds familiar, then The Great Game is the key that helps you break through that fog. The book doesn't teach dry financial theory. Instead, it uses 350 years of real history to explain what capital truly is and how it works. The timeline in the book is crystal clear. It starts in 1653, when New York was still called New Amsterdam. The Dutch built a wooden wall to guard against the British, and the tiny street beside it became the earliest version of Wall Street. Fast forward to 2011, and that little street had grown into a financial empire powerful enough to influence the entire global economy. You'll see that Wall Street wasn't born mighty. At the very beginning, it was basically a hotspot for speculation. The Dutch brought their tulip bubble mentality over, and locals even made money hoarding strings of shell beads, which functioned as currency at the time. Later, when the United States was founded, Alexander Hamilton and Thomas Jefferson argued fiercely. Hamilton wanted to build a national financial system centered on Wall Street, while Jefferson accused him of creating a giant sewer of human corruption. That debate was essentially the starting point of American financial history. Why is this book so useful? Because it's not just telling old stories. It's explaining the living DNA of today's financial markets. Take speculative bubbles, for example. The Dutch speculated on tulips in the 1600s. Americans speculated on railroad stocks in the 1800s. Before the 2008 subprime mortgage crisis, people speculated on housing. The patterns repeat, or take government regulation. In 1907, J.P. Morgan practically saved the entire financial system by himself. After the 1929 crash, the U.S. passed securities laws. In 2008, nations around the world intervened together. The logic hidden inside these events still plays out today. Reading this book also helps build real financial thinking. You'll understand that capital isn't some destructive monster. It builds railroads, helps tech companies grow, and pushes economies forward. But without rules, greed and fear take over, and the market spins out of control, hurting everyone in the end. This type of mindset is useful whether you want to manage your money or simply understand how the global economy works. More importantly, the book reveals the secret of how Wall Street grew. How did a tiny street become the engine of the American economy? How did it gradually surpass London and become the world's financial center? Once you understand that path, you'll also understand the road capital markets are taking today. You'll see what we're trying to build, what we should learn, and what risks we should avoid. So next, we'll follow the structure of the book, starting from the birth of Wall Street, looking at how the Dutch planted the earliest seeds of commercial culture, how Hamilton and Jefferson's rivalry set Wall Street's tone, and uncovering step by step how this financial empire grew into what it is today. Let's continue from where we left off. Since The Great Game explains 350 years of Wall Street's history so clearly, let's start right from the very beginning. In 1653, the street that would one day shake global finance was nothing more than a wall. The Dutch built to defend themselves against the English. Back then, New York was still called New Amsterdam, a colony of the Dutch East India Company. To guard against attacks from the English and Native American tribes, the Dutch built a wooden wall more than 3 meters tall, along the southern tip of Manhattan, stretching from the East River to the Hudson River. The wall didn't stop the English by 1664. They had taken over and renamed the city New York. But the narrow little road that ran along the wall eventually became Wall Street. However, the real seat of finance in Wall Street wasn't the wall. It was the Dutch commercial DNA. The Dutch were pioneers of modern commerce. They created the world's first joint stock company, the Dutch East India Company, the first stock exchange, and even the infamous tulip bubble that shocked Europe. These bold, speculative, profit-driven Dutch settlers brought their entire commercial mindset to New Amsterdam. The first recorded case of financial speculation in Wall Street's history was tied to a Dutchman named Frederick Phillips, a merchant who had emigrated from the Netherlands. At that time, there was no unified currency in the North American colonies. People used wampum strings of shell beads as money. White and black wampum were even recognized as legal tender. Phillips noticed that the supply of wampum was unstable, and many Native American tribes could produce it in large quantities. So he came up with a plan. He traveled quietly into Native American territories, used cheap goods like cloth and tools to buy massive amounts of wampum, and then hoarded it. When the supply tightened and prices surged, he sold it at high prices and made a fortune. Don't think this is some petty trick. It's the earliest form of capital market speculation. Buy low, sell high, exploit information gaps, and profit from supply-demand imbalances. This speculative instinct was etched into Wall Street from day one. Later, railroad stock manipulation, gold cornering schemes, at their core, they weren't much different from Phillips hoarding wampum. But for Wall Street to evolve from a small street into a true capital market, we have to look at the ideological battle after the founding of the United States, the showdown between Alexander Hamilton and Thomas Jefferson. In 1789, the federal government was established. George Washington became president, Hamilton the Secretary of the Treasury, and Jefferson the Secretary of State. Their views on capital and Wall Street could not have been more different. Hamilton was a pragmatic financial mind. When he took office, the U.S. had just finished the Revolutionary War and was drowning in debt. The federal government owed money to the states and owed soldiers their compensation, totaling $54 million, a massive sum at the time. The states themselves were in debt. Currency wasn't unified, and the economy was chaotic. Hamilton proposed a bold plan. First, the federal government would assume all state debts and issue unified federal bonds. Second, the U.S. would create its first national bank, a kind of early central bank, to issue standardized currency. Third, Wall Street would serve as the primary marketplace for federal bond trading, attracting investors and helping stabilize the national economy. His logic was simple. A country needs credit to develop. Issuing bonds shows people and investors that the government is trustworthy. Once trust exists, money will follow. Wall Street, as a trading venue where investors can freely buy and sell bonds, becomes the engine that pulls capital in. Jefferson, however, fiercely opposed him. Jefferson was an idealistic agrarian thinker who believed America should remain a nation of farmers. That stability came from people working their land. He argued that Hamilton's plan would only enrich speculators. People who already held government IOUs, merchants, officers, would profit from bond trading while farmers gained nothing. More importantly, he despised speculation, believing Wall Street would become a cesspool of human greed and corruption, turning America into a nation obsessed with money. Their arguments escalated into personal attacks. Jefferson accused Hamilton of wanting to turn America into a monarchy like Britain, while Hamilton accused Jefferson of being economically ignorant and sabotaging America's future. This wasn't merely a personal feud, it was a defining choice for America. Agriculture or industry, isolation or capital markets. In the end, Hamilton won. In 1790, Congress approved his debt plan, and federal bonds began issuance. In 1791, the first bank of the United States was founded, and Wall Street naturally became the center of bond trading. At first, trades happened in coffeehouses or under trees. But as more brokers gathered, trading volume grew rapidly. This was the first time Wall Street had a serious purpose, moving from scattered speculation to becoming a financing platform that served the nation's economy. But when it comes to Wall Street's organizational structure, we must mention the Buttonwood Agreement of 1792. Many people think this was the start of Wall Street's righteousness. The truth is far less romantic. At that time, brokers fell into two groups: the official brokers who traded inside the exchange with higher commissions and stable clients, and the curbstone brokers who traded on the street with lower fees and frequent fraud. The official brokers felt the street traders were stealing business and ruining reputations. So 21 brokers secretly met under a buttonwood tree at 68 Wall Street and signed an agreement. From now on, commissions between us cannot be lower than 0.25%, and we won't deal with the street traders. In essence, this was a cartel, a monopoly alliance formed to protect their own interests. But ironically, this agreement centralized scattered brokers and introduced unified trading rules, transforming Wall Street from chaotic curbside trading into an organized, rule-based market. That small group eventually evolved into what we now know as the New York Stock Exchange. So the Buttonwood Agreement wasn't the birth of justice, but it was the birth of the organized American capital market. By 1807, Wall Street was no longer that small street beside a wooden wall. It had federal bond trading as its core business, the early form of the New York Stock Exchange, and a group of brokers who understood rules and knew how to trade. But don't forget, Wall Street was still wild, no regulation, speculation everywhere, and brokers did whatever they wanted. As the U.S. economy developed, especially with the rise of canals and railroads, Wall Street was about to face even bigger opportunities, even crazier speculation, and even more severe crises. In the next part, we'll talk about how the Erie Canal ignited Wall Street's first bull market, how the railroad era turned Wall Street into a hotbed of speculation, and what lessons the Panic of 1857 left behind. In the previous section, we talked about how by 1807, Wall Street already had the early shape of a capital market, but it still carried the rough and unruly character of its early days. Over the next half-century, two major events reshaped the American economy: the opening of the Erie Canal and the rise of the railroads. These two developments acted like catalysts, launching Wall Street onto a path of rapid growth while also letting it taste both the sweet side of a bull market and the bitter side of a bear market, completing the first full boom and bust cycle in its history. Let's start with the Erie Canal. In the early 19th century, the Appalachian Mountains stood between the eastern and western United States, making transportation extremely difficult. To ship grain or lumber from the west to the east, you either had to take a wagon across rough mountain roads or follow long, winding water routes, both insanely expensive. Shipping 1 ton of grain from Ohio to New York cost $120 at the time, more than the grain was worth. This geographic isolation left the eastern and western economies almost disconnected. The West couldn't develop, and the East couldn't expand its markets. In 1817, New York's governor, DeWitt Clinton, pushed forward against massive opposition and decided to build a canal linking Lake Erie to the Hudson River, a 584-kilometer project that would become the Erie Canal. Many people at the time thought it was a lunatic's dream. Some even mocked it as Clinton's ditch, saying it would never be completed. But when the canal finally opened in 1825, everyone was stunned. A boat loaded with western grain set sail from Buffalo, traveled smoothly down the canal, and reached New York in just 8 days. Shipping costs collapsed to $6 per ton. The opening of the Erie Canal completely reshaped America's economic landscape. New York overnight became the economic heart of the country. Goods from the West flowed endlessly into New York and were shipped across the nation and even to Europe. Manufactured goods from the East could now be delivered cheaply to the West, accelerating Western development. And for Wall Street, this was a feast. The Canal project needed enormous funding, and the New York state government had no choice but to issue canal bonds. Those bonds quickly became the hottest investment on Wall Street. Investors of all kinds, bankers, merchants, and ordinary citizens scrambled to get a piece. Trading volumes exploded. A previously quiet securities market suddenly became lively, and speculative frenzies over canal-related stocks even appeared. This was the first time Wall Street clearly saw how demand from the real economy could inject massive energy into the capital markets. The prosperity brought by the Erie Canal transformed Wall Street from a small marketplace serving government debt into a major financial platform supporting industrial development, and it ignited the first genuine bull market in Wall Street's history. But the good times didn't last. With the arrival of the railroad era, Wall Street was quickly sucked into an even larger vortex of speculation. Starting in the 1830s, America entered a railway construction boom. Railroads were more flexible than canals, could reach more remote places, and were much faster. But building them cost far more, millions, or even tens of millions of dollars per line. No single company could afford such huge sums, so they turned to Wall Street, issuing stocks and bonds to raise capital. At first, railroad stocks were truly high-quality assets. Once a line opened, freight and passenger revenue was steady. Investors received attractive dividends, and Wall Street flourished along with it. But problems soon followed. With no regulation at all, railroad companies used every trick imaginable to raise money. Some inflated construction costs, turning a $1 million project into $2 million, and then issued extra shares. Some created watered stock, where a company with only $1 million of real capital would issue $2 million worth of shares, with the extra million going straight into the pockets of insiders. The most notorious case was the Erie Railroad. Originally a valuable route from New York to Chicago, it was turned into a cesspool of corruption by a group of speculators. The railroad fell under the control of Daniel Drew, Jay Gould, and Jim Fisk, known on Wall Street as the Rogue Trio. They didn't just issue watered stock. They bribed judges and hired people to spread fake news to manipulate prices. If they wanted the stock to rise, they released rumors about mergers. If they wanted it to fall, they leaked fake financial losses. Erie shares became nothing but gambling chips in their hands. Ordinary investors were tossed around helplessly, many losing everything. During this frenzy, one invention changed the entire structure of Wall Street, the telegraph. In 1844, Samuel Morse introduced the telegraph. Before that, stock quotes had to be delivered by horse-drawn carriage or even pigeons, a full day to reach Philadelphia and 2 days to reach Boston. With the telegraph, New York prices could reach the entire nation in minutes. Local markets were instantly marginalized. Cities like Philadelphia and Boston had their own exchanges. But once investors realized that New York had the fastest information and the most active market, money began flowing there. But faster information also meant more intense speculation. Manipulating prices no longer required slow information gaps rumors, could now spread nationwide in seconds, and stocks could skyrocket or crash within hours. One broker, Jacob Little, became Wall Street's first legendary short seller by cornering stocks and squeezing his rivals. His most famous operation involved Harlem Railroad stock. He bought massive amounts, pushed the price up, waited for others to short it, and then released news that Harlem had secured a government franchise. The stock exploded upward, forcing the short sellers to cover at huge losses, and Little made a fortune. But later, driven by greed, he failed in another speculation and went bankrupt, the first classic example of how speculators on Wall Street rarely end well. Then came the Panic of 1857, a sudden blow to Wall Street's madness. The gold inflows from the California gold rush were slowing down. The U.S. money supply tightened, and excessive railroad building meant many companies were not profitable, leading to widespread bond defaults. The first collapse came from the Ohio Life Insurance and Trust Company, which held large amounts of railroad bonds. Its failure triggered a chain reaction: bank runs, panic selling, a market crash. More than half of New York's brokers went bankrupt. This became known as the Panic of 1857, the first time Wall Street experienced a truly global financial crisis. The U.S. economy had grown closely linked to Europe, and the panic spread across the Atlantic as well. Wall Street finally realized that an unregulated market would eventually destroy itself. More importantly, Wall Street understood it was now tied to the fate of the American economy. The rise and fall of railroads and canals affected Wall Street's survival, and Wall Street's turmoil could drag down the entire nation. After the panic, Wall Street calmed down for a while, but its speculative nature did not disappear. And with the outbreak of the Civil War, Wall Street was about to encounter an even greater opportunity. It would no longer be just a gambling hall. It would transform into a national financing platform and complete its coming-of-age moment. In the next section, a look at how the Civil War helped Wall Street grow, and how titans like Vanderbilt and Gould turned the battle for railroad control into a new peak of financial warfare. The financial panic of 1857 forced Wall Street to cool down for a moment, but before it could fully recover, the Civil War broke out in 1861. This war was a hardship for the United States, but it became a coming-of-age moment for Wall Street. It transformed from a chaotic gambling arena into a financing platform that kept the entire nation running, growing massively in scale and influence. And after the war, the fierce battles among industrial giants pushed the capital market to finally start thinking about the importance of rules. Let's look at how the Civil War reshaped Wall Street. When the war began, the Union government faced one huge problem. It had no money to fight. The war was burning through millions of dollars a day, but the federal treasury was basically empty. Treasury Secretary Salmon Chase first tried borrowing from banks, but banks had limited funds and charged sky-high interest rates. At that moment, a young banker named J. Cook stepped forward. He proposed a brand new financing idea: selling war bonds to the entire public. Instead of targeting only bankers and wealthy industrialists, Cook broke the bonds into small denominations, like $50 each, and sent thousands of agents across the country. They visited small-town stores and rural farms, telling ordinary Americans that buying war bonds was both a way to support the Union and a safe place to put their money, with interest paid at maturity. This down-to-earth strategy opened the floodgates. Ordinary people poured money into war bonds, and some workers even had part of their monthly wages automatically deducted to buy them. In just a few years, Cook helped the Union raise $1.7 billion, an astronomical figure at the time, and Wall Street became the central marketplace for these bonds. Anyone who wanted to cash out or reinvest their bonds went straight to Wall Street. During the war, bond trading on Wall Street exploded. The number of brokerage firms grew from a few dozen to well over 100. Banks and insurance companies clustered around the area, turning Wall Street into the true financial heart of America. The Confederacy, on the other hand, took the opposite route. Unable to issue large-scale bonds, it resorted to printing money to cover war expenses. Within a few years, inflation in the South soared to 9,000%. A $100 Confederate bill couldn't even buy a loaf of bread by the end of the war, and the Southern economy collapsed completely. This proved just how essential a stable capital market is for a nation's survival. After the war, Wall Street was no longer just America's Wall Street. It had become the second largest capital market in the world, right behind London. But the more powerful it became, the more chaotic it grew, especially in the railroad industry. The United States had tens of thousands of miles of railroads, but the system was a mess. Companies fought for passengers by slashing prices, sabotaging each other's tracks, and generally operating without order. This chaos attracted the attention of one giant, Cornelius Commodore Vanderbilt. Vanderbilt had made his fortune in shipping, but at age 70, he decided railroads were the future, so he threw his entire wealth into the industry. His goal was clear: consolidate the fragmented rail network and merge countless small railroad companies into larger, more efficient systems. At the time, the New York Central Railroad was the most important line, but it was controlled by a group of small shareholders who refused to cooperate. So Vanderbilt used a classic Wall Street squeeze. He bought massive amounts of New York Central stock until he owned more than 50%, seizing control of the railroad. But consolidation didn't come easy. Veteran speculators Daniel Drew, Jay Gould, and Jim Fisk targeted him. They controlled the rival Erie Railroad and used tactics like issuing watered-down shares and bribing judges to block Vanderbilt's plans. Whenever Vanderbilt tried to buy Erie stock to take control, they simply printed more shares. Whenever he sued them in court, they bribed the judge and won. This Erie War became a national spectacle. At one point, Gould hired thugs to transport newly printed stock certificates to New Jersey under armed police escort so Vanderbilt couldn't seize them. The two sides even dragged the fight to Congress, and in the end, neither side won. But the fiasco taught everyone a lesson. Without rules, the capital market is nothing but a casino. Even the most powerful tycoons could be played for fools, and ordinary investors were completely defenseless. What truly woke the U.S. government up, though, was the 1869 gold manipulation scandal. Once again, Jay Gould was at the center of it. This time, he attempted something even more audacious: cornering the entire American gold market. The United States was under the gold standard, meaning the government controlled gold prices, but Gould saw an opening. He bribed President Grant's brother-in-law to whisper in the president's ear and push him to stay out of the gold market. Then Gould teamed up with a group of speculators and secretly bought up tons of gold, driving the price from $130 an ounce to $160. Chaos erupted across the nation. Farmers couldn't get enough gold for their crops. Merchants lost fortunes on international trade. Bank runs began spreading again. When President Grant finally realized he was being manipulated, he ordered the Treasury to sell $4 million of gold. Prices collapsed instantly. Gould escaped with minimal losses by dumping his gold ahead of the crash, but countless investors went bankrupt, and the U.S. economy nearly imploded. The scandal taught the United States its first lesson in financial regulation. A capital market must have brakes. It needs an authority powerful enough to stabilize the system and restrain speculators. This idea eventually led to the creation of the Federal Reserve. The crisis also made Wall Street's own giants realize something. Making money through manipulation might work short-term, but it destroys the credibility of the entire market, and sooner or later, everyone pays the price. By 1901, Wall Street was no longer a wild teenager. It had the strength to support the national economy and had begun to develop a sense of discipline. But to truly mature, it needed one more major test: the Panic of 1907 and J.P. Morgan's legendary one-man rescue. In the next chapter, we'll talk about how Morgan used his personal reputation to stabilize Wall Street, and how his actions paved the way for the birth of the Federal Reserve, marking Wall Street's entry into its modern era. After accumulating power through the Civil War era, Wall Street entered a crucial stage of transformation in the early 20th century. It was no longer just a financing platform or a playground for speculation. It began using the power of capital to reorganize entire industries. pushing the United States from fragmented industrial competition toward large-scale industrial consolidation. But behind this rapid growth, enormous risks were quietly building. The panic of 1907 sounded another alarm for Wall Street and ultimately gave birth to the stabilizer of the American financial system, the Federal Reserve. The turning point began with the massive steel merger of 1901, a deal that shocked the entire country. At the time, America's steel industry was a chaotic battlefield. There were hundreds of steel mills, large and small, undercutting each other, using outdated technology, and struggling with high costs. Among them, Carnegie Steel stood out. Its owner, Andrew Carnegie, used advanced technology and efficient management to push costs to the lowest in the industry. But Carnegie was getting old and wanted to sell the company. When this news reached J.P. Morgan, the uncrowned king of Wall Street, he immediately saw a bigger opportunity. Morgan had already consolidated railroads and electric utilities through finance. He knew that merging the steel industry would not only generate huge profits, but also elevate American steel to global dominance. So he approached Carnegie and offered a staggering price, $480 million, more than $15 billion in today's money, and bought Carnegie Steel. Right after the acquisition, Morgan rolled up 78 steel mills, iron mines, and coal mines across the country and formed U.S. Steel. When the company was created, its capitalization reached $1.4 billion, more than twice the annual budget of the U.S. federal government. It controlled 65% of the nation's steel output, becoming a massive industrial trust. Wall Street played the key role in this consolidation. Morgan used his banking network to coordinate capital, issue shares, and structure the merger. He fused industrial capital and financial capital tightly together. This marked a fundamental shift in Wall Street's function. It moved from financing single companies to reallocating resources across entire industries. Through capital, it eliminated outdated production capacity, centralized technology and investment, and drastically boosted America's industrial strength. From that point on, Wall Street truly became the engine of the American economy, not just a place for its own games. But beneath prosperity, crisis was brewing. In 1907, a speculative scheme nearly brought down the entire financial system. A group of speculators attempted to manipulate the stock of the United Copper Company by engineering a short squeeze, driving the price up and unloading their shares at the top. But they overestimated their own power and underestimated the market. Other investors saw through the plot, sold off aggressively, and United Copper's stock collapsed. The speculators were wiped out instantly. Worse, the crash triggered a wave of bank runs. Many banks had loaned money to these speculators. When the speculators went bankrupt, the banks couldn't recover their loans. Ordinary people panicked and rushed to withdraw their deposits. The banks didn't have enough cash on hand and were forced to shut their doors. Within a matter of days, more than a dozen New York banks failed. Countless businesses collapsed, the stock market plunged, and the entire financial system fell into chaos. At the darkest moment, J.P. Morgan stepped forward. He was over 70 years old and in poor health, but he still summoned every major banker and industrialist to his private library and locked the doors. He forced the bankers to contribute to an emergency rescue fund to save the failing banks. He persuaded industrialists to buy struggling companies to stabilize confidence. One now legendary moment came when the New York Stock Exchange was on the verge of shutting down. Morgan slammed his hand on the table and told the brokerage house leaders, "You will put up the money and save this market. If the exchange goes down, none of you will survive." In the end, the brokers were forced to contribute $27 million, and the market slowly stabilized. This one-man rescue turned Morgan into the savior of Wall Street. But it also revealed a brutal truth. The United States did not have a central bank. Every crisis depended on a single heroic figure, and this was unsustainable. After the panic of 1907, the U.S. government finally committed to creating a real central bank, the Federal Reserve. The country had attempted it twice before, but political fights had derailed both efforts. This time, the crisis made it clear that without a central bank, financial markets were like a car with no brakes. After years of debate, Congress passed the Federal Reserve Act in 1913, and the Federal Reserve System was officially born. It consisted of 12 regional Federal Reserve banks, supervised by the government, but with operational independence. Its core responsibilities were to stabilize the money supply, adjust interest rates, and act as the lender of last resort during crises. In plain terms, when banks faced runs, the Fed could inject liquidity to prevent mass failures. When markets overheated, the Fed could raise rates to cool speculation. The creation of the Fed marked Wall Street's true entry into maturity. It meant America's financial system was finally moving from decentralized chaos to centralized stability. After the crisis, Morgan gradually withdrew from the spotlight. When he died, he left only $60 million far, less than Rockefeller or Carnegie. But what he left behind was something more valuable than wealth: credibility. He believed character mattered more than money. Under his influence, the culture of Wall Street began to shift from pure greed toward integrity and responsibility. But Wall Street's story was far from over. When World War I broke out in 1914, the global economic order was reshaped, and Wall Street gained an even larger opportunity. It would soon surpass London to become the true financial center of the world, while also facing far more complex global challenges. In the next part, we'll talk about how the two world wars built Wall Street's global dominance, and how the Great Depression and later crises forced Wall Street to evolve through pain again and again. The birth of the Federal Reserve finally gave Wall Street a stabilizer, and the outbreak of World War I in 1914 pushed Wall Street all the way onto the throne of a true global financial center. But the more power Wall Street gained, the heavier its responsibilities and the greater its risks became. As waves of prosperity and collapse, from the devastation of the Great Depression to the post-war boom, and to crisis after crisis triggered by financial innovation, kept shaping both its global dominance and the deep contradictions inside this financial empire. Before the war, London was the unquestioned financial center of the world, and the British pound was the global currency through which nearly all international trade and financing had to pass. But as soon as World War I began, Europe was overwhelmed by war expenditures, and countries like Britain, France, and Germany not only halted their overseas investments, but also urgently needed American weapons, food, and industrial goods. Yet they did not have enough U.S. dollars to pay for them, and had no choice but to raise money by issuing bonds on Wall Street. Within just a few years, Wall Street became Europe's financial lifeline, with Britain issuing billions of dollars of war bonds, and France and Russia quickly following. And the United States transformed almost overnight from a debtor nation that owed Europe money into a creditor nation to which Europe owed money, while the New York Stock Exchange surpassed London in trading volume, and the U.S. dollar began replacing the British pound as the dominant currency in global trade. Even more importantly, during the war, a large number of European bankers and entrepreneurs fled the fighting and brought their capital and expertise to the United States, and many settled directly on Wall Street, which massively boosted New York's financial strength and left London unable to compete by the time the war ended, marking the first moment in history when Wall Street truly became the world's financial center. But prosperity did not last long, because a larger crisis was already brewing beneath the surface of the roaring 1920s, when America's industrial boom, rising incomes, and easy optimism pushed ordinary people into the stock market. And with almost no regulation, and brokers offering huge amounts of leverage, letting investors buy $9 worth of stock with just $1 of their own, stock prices were driven far beyond their real value, as everyone chased the dream of getting rich overnight, until October 24th, 1929, Black Thursday, when panic selling hit the market and 12.9 million shares traded in a single day, followed by an even more catastrophic collapse on Black Tuesday, and in one day, the market wiped out an amount of wealth equal to 3 years of U.S. federal revenue. After the crash, the United States fell into the decade-long Great Depression. Banks failed in waves, businesses collapsed, unemployment soared to 25%, and millions of families struggled even to eat. And the depression spread worldwide and dragged down economies like Britain and Germany as well. The pain forced America into a new era of strict oversight. And in 1933, the Securities Act required companies to disclose truthful financial information and ban fraud and market manipulation. While in 1934, the Securities Exchange Act created the SEC to regulate stock markets and brokerage firms, placing restraints on Wall Street that pushed capital markets back toward serving the real economy. Then World War II injected fresh power into Wall Street again, as the United States stayed neutral early in the war and made enormous profits selling weapons and materials, while Wall Street helped the government raise huge sums by issuing war bonds. And after the war, the Marshall Plan used Wall Street as the financial hub to channel U.S. capital into Europe, creating a cycle in which America provided funds, Europe bought American goods, and Wall Street handled all the financing. At the same time, post-war technological growth opened a new frontier for Wall Street, as companies like IBM, Microsoft, and Intel rose and needed massive funding for research and expansion. And Wall Street raised that capital through IPOs and let investors share in the technology boom, just as Microsoft's 1986 IPO saw its stock soar from $21 to over $300 and created enormous wealth for early investors. But financial innovation always travels with risk. And in the 1980s, Wall Street began issuing high-yield junk bonds to fund hostile takeovers that left many companies cutting jobs and breaking apart. And on October 19, 1987, Black Monday hit, and the market plunged 22.6% in a single day, its worst drop ever, as computer-driven program trading amplified the panic. The 2008 subprime mortgage crisis exposed Wall Street's dangers even more brutally. When subprime home loans were bundled into mortgage-backed securities and sold around the world, and once housing prices fell and borrowers defaulted, these securities became worthless, leading century-old giants like Lehman Brothers and Bear Stearns to collapse and plunging the global economy into recession. After the crisis, the United States passed the Dodd-Frank Act to tighten bank regulation and curb risky financial practices. But the long arc from 1653 to 2011 shows that crises always accompany booms, because human greed and fear never disappear, and financial innovation never stops, making the real challenge finding a balance between innovation and oversight so that Wall Street can drive growth without triggering systemic collapse. From its rise after World War I, through the devastation of the Great Depression, to the post-war boom, and the repeated crises that followed, Wall Street spent nearly a century solidifying its global financial empire. But this empire has never been invulnerable, because its prosperity and its dangers have always been tightly bound to the fate of the global economy. And next, we'll conclude by asking what the Great Game teaches us about the true nature of finance and what those lessons mean for each of us today. Finishing the last page of The Great Game, and then looking back at Wall Street again, you'll realize that it's 350 years of growth from a small street behind a defensive wall to a financial empire has never really been about how to trade stocks and make money, but about three fundamental truths at the core of finance, truths that haven't changed from the days of trading shell beads in the 17th century to doing financial investing in the 21st century. The first thing to understand is that finance is neither a monster nor a moral hero. It's simply a neutral tool, like a knife that can help you cook if used well, or hurt people if misused. Early Wall Street grew out of speculation. The Dutch hoarded shells and beads, and Gould manipulated gold, which showed the dark side of finance. But later, finance helped America build canals and railroads, funded technology companies, and pushed the nation from an agricultural society into an industrial and technological powerhouse, which showed the good side of finance. What really matters is not finance itself, but the people who use it and the rules that govern it. When finance stays anchored to the needs of the real economy, it becomes an engine for growth. When it breaks away from reality and turns into a pure betting game, it inevitably creates crisis. The second point is that the heart of financial competition is always the balance between human nature and regulation. The repeated stories in the book are, at their core, cycles of greed and fear. In bull markets amplified by capital flows, everyone believes prices will only rise and rushes in driven by luck and herd mentality. In bear markets, everyone fears losing everything and sells in panic. This weakness in human nature has never disappeared from 1653 to 2011. Good rules act, like guardrails that keep those extremes in check. After the Great Depression of 1929 came the siege, and after the subprime crisis of 2008 came the Dodd-Frank Act, each improvement in regulation essentially putting reins on finance so it can move forward more steadily. Finally, the greatest value of this book for us is that it helps us build a rational view of finance. You don't need to envy the speculative legends of Wall Street, because most people who made money by manipulating markets ended badly. And you don't need to fear the complexity of finance, because its underlying logic is actually simple. Capital must serve real needs, and risk and return always go hand in hand. As our capital markets continue to develop, we should learn from Wall Street's original mission of serving the real economy, and at the same time remain alert to its lessons of excessive speculation, so we can find a pace that truly fits us. In the end, the great game is not just the story of Wall Street, but the story of how capital evolves and coexists with human society. We read it not to become financial wizards, but to stay clearer-headed and less blindly influenced when facing money, markets, and the future. And that is the most precious gift this book leaves us. And finally, congratulations. You've finished another book.